Are you currently investing in the most overvalued stock market in US history? You might be. This is a chart of the Shiller PE ratio for the S&P 500, which is a very common valuation metric for stocks. You can see that right now, the S&P 500 is sitting at the second most overvalued it's ever been, second only to the dot-com bubble. Now, if you want to take a look at just the straight up PE ratio for the S&P 500, you can see we aren't quite at the second highest in history, but we are at the fourth highest PE ratio. The couple of spikes that have exceeded the current PE ratio were the bubble that happened in 2020 and 2021 after all the money printing, obviously the dot-com bubble, and then we have a brief large spike in valuations when the recession from the financial crisis hit before stock prices fully adjusted down. But that's not all. We also have what's called the Buffett indicator. This is the Wilshire 5000 index compared to GDP. Now, you can see for years now, this Buffett indicator has been very elevated compared to where it usually is, especially for, a century prior. But even just zooming in on the last couple of years, you can see the Buffett indicator is the highest it's ever been. So should you run for the hills, sell everything, maybe even short everything, buy a bunch of puts? Not so fast, because the question is not, are stocks overvalued? The proper question is, compared to what? I would like to highlight for you the PE ratio of this specific stock index. You can see it reached 6,000. Before I show you what index this is that hit a PE ratio of 6,000, this is currently, by the way, this is not in the past. I want you to take a look at one of the most overvalued stocks in the S&P 500 right now with a price to earnings ratio of 676. If you're not familiar with a price to earnings ratio, it takes the price of the stock and then it looks at how much money the company earns in profits, not revenue, how much it keeps in profits, and compares those two as a ratio. To understand what it means, you just say, okay, if this company decided to pay out as a dividend 100% of its profits every year, how many years would it take for me to get back the price per share? For Palantir right now, as of the time of this recording, that would be 676 years. If they took all their profits and paid 100% of profits out as a dividend every single year, you would get back your price per share, your initial investment, in 676 years. That is nothing compared to this entire index, which isn't even just one stock. As an outlier compared to the rest of the stocks in the index, this is the entire index has a PE ratio of 6,000 and a staggering price to sales ratio of almost 2,700, meaning if you did the same thing, but instead of paying out profits, you paid out all of your revenue and you could just ignore your expenses, it would still be 2,700 years before you could pay back the cost of investing in the entire index. So what index is this? Well, you might not be surprised, but it is the stock market in Venezuela. Now, you might rightfully be thinking that it's not really fair to compare overvaluations in stocks in the United States with extreme valuations in a country going through actual hyperinflation. And you're right about that. However, I'm pointing out the extreme to answer the question, well, how high can it go? How much more overvalued can stocks get? The answer is, it depends on what the denominator does. Why are people investing in those stocks in the first place? 100 years ago, when you invested in a company, the only reason you would do that is because you had a high degree of confidence that that company was going to produce profits and pay those profits to you. But in a world of constantly devaluing fiat currency, that is not the primary consideration anymore. More and more today, the primary consideration when making an investment is this going to at least protect my purchasing power from inflation? And the reality is, as expectations of future currency devaluation increase, so does the trend of buying assets at higher and higher valuations. Because despite the fact that they're expensive, it's still better than the alternative. Now, that thought experiment alone does not prove anything, because in the past, when we've seen crazy high valuations, we've seen the stock market correct. Like during the dot-com bubble, it finally burst valuations came back down to a normal level again. So just noting the fact that people want to protect their purchasing power, and so they're willing to invest at higher and higher prices, does not mean that you shouldn't be careful of overvalued assets. But anytime somebody says something is cheap, expensive, overvalued, undervalued, you always have to ask the question, compared to what? This is the chart of the S&P 500 priced in gold instead of dollars. For reference, this is the S&P 500 priced in dollars. So when you price the S&P 500 in terms of gold instead of dollars, you get a much different picture. This run up and then crash you see was the Great Depression. This run up that you see following the 1940s is the post-Bretton Woods Agreement. This crash that you see starting around 1971 was from the end of the Bretton Woods Agreement, delinking from gold and having gold skyrocket to its proper value again. So stocks relative to gold became very cheap again. This big run up in stocks compared to gold was the dot-com bubble. This collapse in the price of stocks compared to gold was both the crash in stocks that happened as of the dot-com bubble bursting and the great financial crisis, but also the bubble that occurred in gold up until 2011. Stocks have had some massive bull markets since then, but also so has gold, which has put the current pricing of the S&P 500 compared to gold in a very normal and comfortable range, historically speaking, going all the way back to the 1960s. Now, if pricing stocks in gold doesn't prove the point by itself, let's price something else in gold that also seems historically overvalued right now. And that is US real estate. You might be shocked to see this chart, but homes in the United States are not expensive right now when priced in gold. In fact, they're at one of the cheapest places they've ever been. So with some of these assets like Bitcoin and real estate and the stock market being at some of the highest prices they've ever been in history, and these valuation metrics like the Shiller PE ratio and the Buffett indicator being at the most extended they've been, it's becoming clear that these things are expensive compared to dollars, which means that maybe the problem is not with the valuation of the assets or the price. Maybe the problem is with the denominator, the dollar. I mean, just look at this chart again, which is the chart of the stock market in Venezuela. You'd look at a chart like this if you didn't know what it was and think, man, that is something I would have liked to own. It just goes straight up. And that's the point. When the money is being devalued, people buy whatever they can to protect their purchasing power. The value or traditional valuation metrics matter less and less. This shows that valuation extremes today indicate that there's a growing expectation that the near future will experience dollar devaluation from excess government spending, excess government borrowing, and inflation. Now, don't get me wrong. I definitely am not saying this means that there's no crash coming, that crashes can't happen. In fact, even in a place where the stock market looks like a hockey stick, in 2018, it still suffered a collapse of 94% in dollar terms. Extreme volatility and crashes can absolutely still happen, even if there is a flight or a panic into safety. In fact, if anything, this means that you need to be more and more careful with the assets that you choose, what percentage of your portfolio you are putting into each asset, and that you know how to do proper valuation yourself. If you don't know how to hedge your portfolio, how to protect your assets from inflation and from crashes, and how to pick high quality stocks, and then finally to know what price you should be buying them at, don't worry, I've got you. I have laid out a step-by-step plan that teaches you exactly how to do every single one of those things. It's called the Hedged Hypergrowth Portfolio Blueprint. I've got it linked for you in the description below. Go check it out. As always, thank you so much for watching. Have a great day.